The UAE, Singapore, Switzerland, Panama. Ask any cross-border wealth advisor where the rich move for tax reasons and you'll hear those 4 names. But each one fits a different investor profile and has a different cost. Pick wrong and you could lose millions. By the end of this video, you'll know exactly which regime fits your situation, and we'll close with the country aggressively pulling capital out of one of these 4 right now. Quick note, this video is not tax, financial, or investment advice. Consult the IMI pros on imidaily.com for credible, actionable guidance. Now let's start with the simplest of the 4. The UAE imposes no federal or emirate-level personal income tax on salaries, dividends, capital gains, or investment income, and according to PwC, there is no government plan to introduce one. For business owners, corporate tax kicks in only once annual turnover passes 1 million dirhams, roughly $250,000. The rate is 0% up to 375,000 dirhams of taxable income and 9% above that. Although a 5% VAT covers most goods and services, personal investment income, salary income, and real estate income are excluded. Crypto transactions have been VAT exempt since November 2024 under Cabinet Decision 100 of 2024, applied retroactively to January 2018. The way most investors land in the UAE is the Golden Visa. The requirement is straightforward. Own local real estate worth at least 2 million dirhams, around $545,000 in a freehold zone. The visa runs 10 years, renews automatically, and imposes no minimum stay requirement. Moreover, investors can sponsor their spouses, children, and parents, and as of February 2026, mortgaged properties qualify too after the upfront payment rule was scrapped. But here is where the UAE breaks from the other 3 tax havens we'll cover shortly. There is no clean path to permanent residency or citizenship. Naturalization is granted only by presidential decree for a narrow category of exceptional contributors. Example, Kevin O'Leary. The Golden Visa is a renewable long-term residence permit anchored to the underlying investment. Don't consider the UAE a citizenship play. Regionally, the UAE now has competition. Oman is set to introduce the Gulf's first personal income tax in 2028. Saudi Arabia and Kuwait have flagged fiscal pressure on their own zero-tax models. The UAE is the regional outlier in keeping their personal tax base at zero, partly because attracting wealthy investors is now structurally embedded in their economic model and strategy. For an internationally mobile earner whose wealth sits offshore, who wants the lowest defensible tax bill in a major financial hub, and who is not chasing a passport at the end, the UAE delivers the lowest direct tax cost of the 4 jurisdictions we'll discuss in this video. But US citizens, of course, still owe the IRS regardless of where they live. Now, if a passport is part of the long-term plan, Singapore could tell a very different story. Singapore's resident progressive rate runs from 0 to 24% on locally sourced income, with the top bracket biting on chargeable income above 1 million Singapore dollars, or almost $800,000. The structural advantage for relocating high net worth individuals is the treatment of foreign source income, which is generally not taxable when received by a Singapore resident individual. Plus, capital gains are not taxed at all. There is, however, a wrinkle. In force since January 2024, Section 10L treats certain foreign-sourced disposal gains as taxable when remitted into Singapore by corporate entities of a multinational group that lack adequate economic substance in the city-state. Individual investors managing personal wealth are generally outside its scope. So, high-net-worth individuals holding foreign assets through corporate vehicles need to plan around it. The immigration route into Singapore is typically the Global Investor Program, administered by Singapore's Economic Development Board. There are 3 contribution options. Option A requires 10 million Singapore dollars into a new or existing Singapore business. Additionally, applicants must build a business that employs at least 30 staff in Singapore, with at least half holding Singapore citizenship or PR, and create at least 10 new local jobs within 5 years. Option B requires 25 million Singapore dollars into a government-selected fund. Option C requires 50 million Singapore dollars into a single family office with at least 200 million in assets under management. This route also requires 5 investment professionals on the family office payroll with at least 3 Singapore citizens. The headline physical presence requirement is 1 day a year. The renewal mechanics are stricter than that sound though. A 5-year re-entry permit renewal requires the principal applicant or all dependents to have spent more than half of the previous 5-year period cumulatively in Singapore. A 3-year renewal can be granted on either criterion alone. Singapore opens citizenship after 2 years of PR. It is fully discretionary. The bar is high and dual citizenship is not permitted. Moreover, male children with permanent residency granted through the Global Investor Programme become subject to national service. Yes, military conscription. The numbers also tell you how exclusive this program actually is. The Singaporean Parliament recently confirmed the GIB approved 450 investors over the decade, from 2015 to 2025, channeling around 930 million Singapore dollars into the economy. For an investor whose wealth is structured around active business or family office substance, Singapore offers something the UAE and Panama cannot: a financial hub of comparable depth to Hong Kong and a credible, even if discretionary, path to arguably the world's strongest passport. Of course, the price of admission is materially higher than any other program in this video, which brings us to the program that's more expensive still, but in a different way. Switzerland is not a low-tax country under ordinary rules. Top marginal personal rates exceed 40% in Geneva, Vaud and Bern, once federal, cantonal and municipal layers stack. The workaround is the forfait fiscal, or expenditure-based taxation. Instead of taxing actual worldwide income and wealth, the cantonal authority agrees a deemed expenditure base with the taxpayer, applies ordinary rates to that base, and that's the bill. We covered this in detail in our video called How Do the Rich Move to Switzerland? These 5 ways. Check that out if you want a deep understanding of the country. For the 2026 tax year, the federal floor for the deemed expenditure base is 435,000 Swiss francs, or about 550,000 US dollars, set by federal ordinance dated September 2025 and in force since January 2026. The base must equal at least the hire of 7 times the annual rent or rental value of the Swiss residence, or 3 times annual hotel costs for boarded accommodation, or the federal floor, or actual worldwide living expenses. But watch out, cantonal floors apply on top. Minimum annual bills run from around 250,000 Swiss francs in lower tax cantons to over 1 million in Zug or Geneva. 5 cantons no longer offer lump sum taxation. For example, Zurich abolished it in 2010 by referendum. Basel-Stadt followed in 2012 by parliamentary decision. Basel-Landschaft, Schaffhausen and Appenzell-Alderhausen have since done the same. The eligibility rules for this regime are narrow. Applicants must meet all the following requirements. 1. Hold foreign citizenship. 2. Take up Swiss residence for the first time or return after at least 10 consecutive years abroad. And 3. Refrain from gainful employment or business activity in Switzerland. Managing personal wealth is fine. Running a Swiss business is not. Demand for Swiss residency and inclusion in the forfait fiscal regime is growing. The State Secretariat for Migration reported 496 non-EU and non-EEA nationals holding lump sum permits as of March 2025, a 22% year-over-year increase. Russians led the applicant pool, followed by Chinese, British and Americans. Geneva alone hosts a quarter of all lump sum residents. But 2 policy risks deserve your consideration. The first is a population cap initiative going to Swiss voters in June 2026, which would impose a hard ceiling of 10 million permanent residents by 2050. If you're watching this video after the referendum, check IMI's coverage on the website to learn whether it passed. Advisors quoted by IMI believed the practical hierarchy of restrictions would target asylum seekers and short-term residents before lump sum taxpayers, but the constitutional path runs through Parliament and could be diluted. The second is the recurring referendum risk that more cantons follow Zurich's elimination of the program. Switzerland could be, for some investors, the most expensive of the 4 jurisdictions in this comparison. Yet it's also the most predictable. The bill is agreed in advance, indexed to the federal floor, and decoupled from actual income. For wealth concentration in volatile or hard-to-value assets, that predictability has value. Still, if Switzerland sits at the high end of the cost spectrum, Panama sits at the low end. Panama's territorial tax system applies a progressive rate of up to 25% on locally sourced employment and business income, and exempts foreign-sourced income and foreign asset capital gains entirely from taxes, even when funds are deposited in Panamanian banks. Plus, the banking system is dollarized, which removes currency risk for US dollar-denominated wealth. The primary immigration route into Panama is the Qualified Investor Visa, established by Executive Decree 722 of October 2020 and amended by Decree 193 of October 2024. The real estate threshold requires at least $300,000 US in local purchases, but only until October 2026. After that, it reverts to $500,000 unless the government extends the current rules, which is entirely within the realm of possibility since they've done at least once before. Alternative routes on the Qualified Investor Visa require $500,000 US in Panamanian listed securities, or a $750,000 US fixed-term deposit held for 5 years. Processing typically completes within 1 to 3 months, and permanent residency is granted immediately on approval. For citizens of more than 50 designated countries, the Friendly Nations visa offers a lower cost route at $200,000 US in real estate. Since the 2021 reform, that one grants a 2-year temporary permit first before conversion to permanent residency. Panamanian naturalization eligibility opens after 5 years of permanent residence in the country, but the process is steep. Spanish language assessment on Panamanian geography, history, and civics administered by the Electoral Tribunal, and presidential approval of the naturalization application, and a constitutional declaration expressing intent to renounce any prior nationality or nationalities, though enforcement of this rule varies in practice. In a 2025 interview with IMI Panama's Vice Minister of Internal Commerce, Eduardo Orango, framed the program as Panama's attempt to emulate Portugal's Golden Visa model. He told us North American applicants had overtaken Colombians as the largest source nationality, thanks to a dollarized currency, predictability, and direct flights to North American cities. A couple caveats here though. Panama is on the EU list of non-cooperative jurisdictions for tax purposes as of 2026, which means EU-based investors face punitive withholding taxes, denied deductions, and controlled foreign company rules on certain Panamanian source flows. And Panamanian banking compliance has tightened considerably since the 2016 Panama Papers disclosure. Opening bank accounts requires extensive source of funds documentation, and timelines have lengthened a bit. Panama offers the lowest cost of entry in this comparison, a clean territorial tax model, and a 5-year naturalization eligibility path. The trade-offs are EU blacklist grey area, banking friction, and a less powerful passport as the others on this list. So we have all 4 on the table. Here's how they compare. The 4 programs don't sit on a single spectrum. They sit on 4. On foreign income tax burden, the UAE and Panama both charge 0%. Singapore charges 0% in principle, subject to the Section 10L narrowing for some disposal gains. Switzerland charges whatever rate applies to the agreed expenditure base, anywhere from 250,000 Swiss francs to over $1 million a year, regardless of actual income. On cost of entry, Panama starts at $300,000 US as of today, while the UAE requires roughly $545,000. Switzerland costs the cantonal tax floor plus a residence appropriate to the lifestyle calculation. Singapore demands a minimum of 10 million Singapore dollars, scaling to 50 million for the family office route. On citizenship optionality, Panama opens naturalization after 5 years, but is selective in practice. Singapore opens after 2 years of PR, fully discretionary with no dual citizenship and national service exposure for male children. Swiss citizenship is possible under ordinary naturalization rules after more than 10 years, with the lump sum regime ending the moment you naturalize. The UAE offers no realistic citizenship pathway at all. On policy durability, the UAE and Singapore have run consistent investor residency policy for the past decade, with limited surprises. Switzerland continually faces referendum risk at both the cantonal and the federal level. Panama carries a documented history of adjusting policy to international transparency standards, and the qualified investor visa threshold itself is technically scheduled to rise this October. Which brings us to the question that actually matters: which is for you? If your top priority is the lowest defensible tax bill in a major financial hub with no naturalization ambitions, the UAE wins. If you need genuine permanent residency and a credible discretionary path to a top-tier passport, can absorb an 8-figure entry ticket, and accept the operational substance Singapore demands, the Global Investor Program wins. If your wealth is large enough that a 500,000 Swiss franc annual bill is a rounding error, prefer Central European access, and you value the predictability of paying a fixed amount agreed in advance, Switzerland wins. If you want the lowest entry into a territorial tax system with a 5-year citizenship possibility, and you can structure around any financial blacklist exposure, Panama wins. This is exactly the kind of conversation we have in the Sovereign Signals calls. IMI Sovereigns is our private community for investors and entrepreneurs, and every recurring Signals call covers program changes, emerging opportunities, headline news, and the tax strategies we just walked through. We even have a special discount for video watchers like you. Link to join in the description. Before you go, there's one more thing anyone shortlisting these 4 needs to know. Becoming a tax resident somewhere new is not the same as ceasing to be a tax resident where you came from. The exit cost of leaving a high-tax country, exit taxes, departure taxes, residual ties tests often determines whether any of these programs make sense at all. Get out cleanly and the strategy works. Don't, and you can land in 2 tax nets at once. Which brings us back to the loop we opened at the start. There's a 5th country that didn't make our list today, but that could in the future. Turkey has proposed a 20-year foreign income tax exemption and paired it with the country's long-running citizenship by investment program. The strategy under President Erdogan is to siphon capital and talent directly out of Dubai, with a passport on the back end the UAE can't offer. We covered it in the video on your screen. Watch that video next, subscribe so you stay in the loop, and turn on those notifications.